Jeremy, let's get your forecasting hat on. A, what's the upside through the end of 2017? And B, let's go big fry. Let's forget about Dow, 2,200, 22,000, should I say. What about Dow 30,000, Jeremy? Give me an answer to both those questions.
Well, we're 2230. What is that? That's about another 35, 40% increase. How many years you need Dow? If Dow goes up 7% a year, that with a 2% inflation, that is a 5% return. Compounding, what are we talking about? 5 to 6 years. Now that's an average. One thing we know about stocks is, they could go up 20% and down 20% in a year. Dow 30,000 is going to happen. Whether it happens before the end of this decade, I tend to doubt it. Not impossible, but I think we're looking at the early 2020s for a Dow 30,000.
Well, what is your sort of near-term forecast that you're working from, Jeremy?
Yeah. At the beginning of the year, I did say that 10% was possible this year, and we're very close to that. And most of it has been on the back not of the Trump agenda, but of certainly good earnings and a lower dollar. That's been very, very important for boosting earnings. I still think a corporate tax cut is coming this year. I think that could raise after-tax earnings another 10%. I know there's a lot of pessimism after the fiasco with the health care. I actually think that makes the Republicans more determined than ever to say, well, let us get something on taxes. And actually, corporate taxes is where I think there is more agreement. So I think that if we do get a corporate tax cut, and I think 2017 is still possible, that's another 10% in the market. It may not be till 2018, but I think that is a wild card. That is positive and something that has a very good chance of happening.
And Jeremy, if we get the beginning of quantitative tightening or the tapering of the balance sheet, along with an interest rate increase in December, does that impact your forecast there for stocks at all?
Interest rates are still extremely low. one to 1.25, it goes 1.25 to 1.5. The long bond is a more important indicator for the stock market because stock market is a long-term asset, stocks, equities, and so are the long bonds. And I'm not worried about a quarter point. Now, as far as selling the balance sheet, that's some extra supply. The demand for treasuries has been very, very good over the last 5 or 6 years. But the Fed is going to add to the deficit in the way the deficit is going to have to fund them another $500 billion of treasuries, and the Fed is going to supply $200 billion. So there is a little absorption to do on that side. But the only time I see bad things on the stock market is a little more inflation or a little more real growth. And that's not bad for earnings, certainly not in the short run. We need inflation. If inflation gets to 4, 5, 6%, that's what Greenspan is worrying about. But I do not see that in the cards at all.